So the next is panel discussion. And to introduce the moderator of our panel discussion, may I request our new member, Hani, to introduce the moderator.
Hello everyone, good afternoon. My name is CA Hani Mehtani, and I'm here today to introduce our moderator for our panel discussion, Mr. Krishnan. Mr. Krishnan is a Vice Chairman of Abu Dhabi CA Chapter and Partner Tax and Advisory in Anderson in UAE. Krishnan is a Chartered Accountant and Cost Accountant having more than 23 years of experience in UAE. He served in manufacturing, trading, and aviation industry at various capacities. He is having expertise, knowledge, and experience in advisory services, IFRS, internal audit, value-added tax, reporting standards, risk management, process re-engineering and mapping, treasury, and forex operations. He has niche experience in VAT automation across various segments, which includes BFSI, aviation, healthcare, oil and gas, retail, real estate, etc. He assisted various clients in end-to-end VAT implementation, which includes determining the financial impact of VAT on their businesses, review of operating models to assess tax optimization avenues, review of contracts, ERP, business processes to suggest changes required from VAT perspective, etc. So let's welcome Mr. Krishnan over the podium. Thank you.
Thank you. Good afternoon, everyone. Now, we are standing between you and the lunch. Anyhow, when we are hearing, this is a good session which is going on. So we would like to continue for another 30 minutes this session. So hope all the members won't mind, because it is good that we are having a session after a long time, and this is going to be a session which we are going to do it regularly. In the panel discussion today, even though the subject matter expert has covered quite a lot of topics, still we'll have some question and answers, and if members wants to ask more questions, they can also free to join and ask questions. In the panel discussion today, we have Janardhan Singh from Mayur Batra Group, then Shruti from HLB, then Amit from UHY. So Amit and Shruti was already introduced, so let me take the pleasure of introducing Mr. Janardhan Singh. Janardhan Singh is a designated COO at MBG Corporate Services India and is a partner of Direct Tax Practice. Mr. Singh has over 14 years of post-qualification experience in tax consulting, dealing with the matters pertaining to international taxation, corporate taxation, expatriate taxation, and transfer pricing. Mr. Singh has focused on international tax and corporate tax related to EPC contracts, project office, operations as his area of specialization. Mr. Singh has possessed an insight of various direct tax issues faced by multinational enterprises. Mr. Singh has done extensive representation at assessment and appellate level and has been associated with big consulting firm. He is a qualified chartered accountant and holds the title of Fellow Chartered Accountant with the Institute of Chartered Accountants of India. May I request everyone to join with me in welcoming Mr. Janardhan Singh. Along with him, may I welcome Shruti and Amit for the panel discussion. Sit on this, yeah, either of this. Yeah, please. Hope everybody will agree that today we are a very insightful session, and the public consultation document which has been released on April 29th. But it is sad to understand that very few members had gone through the public consultation document. The MOFA, the Ministry of Foreign Affairs, and FTA has issued a public clarification, the public consultation document to get a feedback from the members, in particularly from the chartered accountants, so that they can, whatever is the changes required in the final decree or the executive regulations, they can incorporate it. Very few members from our chapter also has sent us the recommendation. But overall, I believe there are a lot of recommendations have gone to the FTA. Hopefully, many of the consultations, many of the documentation which has been sent by the consultant will be incorporated in the final decree law. We are expecting the final decree law to be issued, might be in a month or so. So let's look forward that all the clarifications or the doubts which have been raised by various people have been answered. Let's begin the panel discussion with a couple of questions to our members. My first question is to Mr. Janardhan Singh. So basically, even though the VAT has been introduced over here, first couple of years, everybody is feeling the glitches. Still, many people are finding it difficult to adopt the VAT, and many are slightly worried on the VAT audit yet. Janardhan, that being the case, the tax is going to be introduced from 2023, June 2023. How do you feel that whether the companies will be prepared for the VAT, for the corporate tax, and what are the areas in which the companies can improve, and whether it will be whether it will be easy for them to comply with the laws and regulation which will be on the corporate tax?
Good afternoon, everyone. It seems that it is a very basic question, but it is a very relevant question, because someone rightly said that taxes and death are the two things which are constant in this world, and the UAE was the exception up till 2017. Now, after introduction of VAT, they have also introduced corporate tax, and due to introduction of VAT 4 or 5 years back, all companies are having some sort of experience that whenever any new law comes, we have to take some understanding about the same. So first of all, every company has to see that the current law in its shape and form seems very simple, but it is not the law per se. It is a public consultation document in which government has only given and shared their view that yes, they are going to introduce the corporate tax, and these are the areas which they are going to cover. So once the final law will be there, we have to go through in detail. So every company has to do the impact analysis, and basis the impact analysis, they have to implement each and everything properly and within the time, so as to avoid any future litigation. So even if it seems that it is a very simple law, but I can assure you on the basis of my experience in other jurisdictions that when law is simple, even then litigation is very high, because government has their own view and interpretation of the law, and the entities and the taxpayers have their own way. So right now, our main focus should be to structure and understand these provisions properly, so as to implement, so as to make all the arrangements within our group, within our entities. So after that, litigation, if you say or ask, then litigation can't be avoided. It is something in the matured jurisdiction. We have seen many litigation on taxation.
Yeah, what you're saying is right. Even though when the VAT was introduced, everybody is saying VAT is a very simple law. Over here, it is only 5%. Yes. But even after four years, still people are struggling to cope up with the tax audit, VAT audit.
Yes.
Then if may I ask you, what are the key 3 areas where the where the business should be planned for the corporate taxation?
So if you ask me the key areas, so as in my earlier question, I mentioned that first of all, we have to make proper understanding by the impact analysis on our own group. What happens, we go through the law in a very basic or in a very broad terms, but we have to see how our organizations, how our groups are placed. What are the lacunas which needs to be plugged before 1st June 2023. So in this, first key area is to make the impact analysis. Second is to make the proper arrangements for the compliances. And third is to identify all expenses. What expenses are related to business and what are not related to business. Because in corporate tax, the main litigation evolves around the allowability and disallowability of the expenditure. Every time taxpayer says that these expenditure are very relevant for my business and these are related to my business, but the tax authorities are not of the view, you have to substantiate those expenditure are requirement of your business. So we have to segregate expenditures as per the business requirement, because up till now all expenditures whatever we incur in our companies or in our groups, we consider it because mainly the accounts are prepared for the purpose of the shareholders to know the profitability. But now the stakeholders have been increased and the government is also keen to know your profit so as to tax it properly.
Do you aware what are all the business expenditure, what are all the expenditure which are disallowed in the corporate taxation? Anyone would like to share what are all the expenses which are disallowed in the corporate taxation? Up to what limit it is allowed? Entertainment expenses up to 50% is allowed. 50% is allowed. The remaining is disallowed, being it the supplier, customers, and customers or with any third party. The same way, 30% of interest expenditure is allowed before EBITDA. So, in case, even if it is a group transaction, they have to be done with the arm's length transaction. The same way for the VAT and other administrative expenses, those are all disallowed. And another thing which has been mentioned in the public consultation document is any expenditure which is not earned with regarding to the taxable income may be disallowed. So more clarification will become when the decree will be coming. At the time, more clarification we will be getting it.
Very rightly, Mr. Krishnan has mentioned that there are only few expenditures on which PCD is mentioning, but there are very long list of such type of expenditure which our groups may be incurring currently. For example, payment of membership fees. Right now, we can claim any type of membership fees expenditure, be it related to directors, board of directors, managing directors, or the staff related. But in future, we have to substantiate by the documents and we have to explain before the tax authorities that these memberships are not in the personal capacity of our key management. These are the requirement of our business. So likewise, there are various other expenditures which may be there, for which there will be a mention in the final draft.
Okay, thank you, Jonathan. Amit, the next question to you is what triggers a permanent establishment in a foreign jurisdiction?
Yeah, actually, this is, I would say, in generally, any company, any business performing any activity in a I would say foreign land or outside his home country and generating revenue, or I would say adding value to the core activity, that considered as a PE. So it's a general definition that is one can understand to consider to determine the PE. However, the detail, I would say the specific guidelines has been provided in Article 5 of OECD Model Tax Convention, which specify that in UAE, what would you say, to determine the PE, one need to follow the two tests. If it is proved from the test, they have a PE, subject to, I would say, so many other things, which is there. I would say the degree of permanency or with respect to the anti-fragmentation rules, then they would qualify as PE and accordingly should be taxed profit attributing to that PE.
Okay, generally in international guidelines, okay, if it is more than 6 months of the place of establishment, then only the PE guidelines will follow. The same rule will be applicable for UAE also, or it is going to change based on the dependability test and the establishment test?
If we go for the degree of permanency rule, it is standardized, and since UAE has already been mentioned in PCD, it will going to follow the rules that is provided in Article 5 of OECD Model Tax Convention, which says that we generally accept the permanency level of 6 months. But contrary, there are so many other, I would say, decision has been taken in particularly, I would say, one decision I was reading which was taken by Sweden Court of Rules. It was mentioning that permanency they were keeping at a period of 4 months instead of accepting the general rule of 6 months. So definitely UAE will go with the standard rules as provided in Article 5, but yes, still there could be, we can expect some changes as per the UAE own requirement and tax parallels.
Okay, fine. Okay, in public clarification document, particularly on PE, it has been mentioned that the employees of free zone working from home will be considered as a part of PE determination.
Yeah.
Whether how we justify it, basically if you are saying that people working from home, for example, if it is a free zone company, if people working from home from the mainland, whether that will be considered as a free zone activity or whether it will be considered as a mainland activity.
So firstly, that if we are talking about the work from home or employee home office, the condition again we need to check upon the degree of permanency or degree of continuity, I would say. Not only that, one need to check what are the arrangement is being made. If let's say employees is continuously working from 6 months, I'm just talking about a general regulations or general rules. If the employee is regularly working for more than 6 months from home, and along with that the company has contributed or a foreign company is contributing to the cost of maintaining their workplace in home, or they are allowing some extra allowances to continue their operations from their home, then definitely that would fall under the ambit of, I would say, fixed place of business, and ultimately would be considered as PE. So it's not straightforward to say that yes, if the home office is there or from where the employee is working or they are working from home, there are other conditions also that need to be justified, to be satisfied, to ensure that, to substantiate, yes, actually it has been done to avoid I would say, to avoid PE. So other conditions also need to be checked.
Okay, fine. Okay, my next question to you, Shruti. So basically we are talking about one of the hot topic is the free zone. So which everybody is keen, particularly in UAE, the free zone is one of the main activity over here. See, there are many provisions in the public clarification document which talks about the exemption or the zero rated for free zone transaction. That being the case, the company which are in mainland, do you think there will be a shift from the mainland to free zone to avail the exemption?
So yeah, we are not expecting a big shift from mainland companies to free zone, because again, it has their own free zone free zone persons, even with the advantage of having 0% corporate tax rate, it has its disadvantages as well. So every company who wants to shift from mainland to free zone would have to take a decision based on the incentives or based on the advantages that it would get. Like I explained in my slides, if it has passive income, then maybe shifting and having a free zone person would make a difference. So each on its case, based on the transactions that primarily the mainland enters into, it can take their decision based on the benefits and the tax saving mechanism it might have. So it needs to be taken care accordingly, based on the transactions that primarily the mainland companies have.
So basically currently in the free zone, only for the passive income, for a company which are in free zone, only passive income will be classified as zero rated, right? The remaining active income will be considered, in case if there is any active income, all their income, irrespective whether it is a group company transaction or whether it is a third party income, everything will be falling into the subject rate of 9% corporate tax?
Our view is yes, it would, if the company is able to bifurcate those transactions of active income and passive income, then yes, they can take the benefit of 0% corporate tax rate on the passive income and charge and have the regular rate of 9% on the active income, though it will be very difficult and difficult to prove, but then otherwise then there's no logic of having that limited income. So our view is that yes, if they are able to bifurcate, they can take the benefit.
But in the public clarification document, if you see that it is mentioned specifically only for the passive income.
It
so
is,
in case if it says any other income, if it has been generated, then it will be subject to the corporate tax of 0% benefit will
So the
be
public consultation document is talking about, is saying the word limited to passive income, which is interpreted differently. So I would say then your interpretation is limited to passive income is only passive income. Our interpretation is passive income and active income. If we are able to bifurcate, we can take the benefit.
Okay, would you like to have what is your view with regarding to the passive income and active income which has been generated by free zone? Do you have any other view, or you are saying that in case if there is any active income, then all the benefits which are being availed by the free zone will be going away?
So as per the PCD, it is very much clear the intention of the government, as per my understanding and my view, that they are only want to give this exemption to the passive income, not for the active income. Because if we see in the case of P concept also, every country wants to tax the income which is directly generated from their mainland, not the passive income. So in other jurisdictions, even passive incomes are taxed, but they are generally covered with the lower tax rates. But in UAE, they have categorically mentioned that they are not going to tax the passive income because they want to tax only the activities which are carried on their land. So I think whatever categorization is given, all type of passive incomes which are generally known are covered, but in final tax law, if there will be any other addition, that we have to see.
Okay, fine. Okay, again, next question to you only, Janardhan. So what are all the risk areas from transfer pricing, benchmarking and documentation perspective?
It is a very relevant question because in PCD, there is only a broad line which is mentioned that they are going to incorporate transfer pricing in their corporate tax, and basically all OECD related rules will be applicable. But it is not very much simple in case of UAE, because in UAE what they have introduced is the rate of 9%, which is still lower as compared to other jurisdictions. So the chances of shifting or shifting of profit is very low in case of international transactions. The main areas of concern for the UAE entities, if they are dealing or having transactions with the free zone, mainland entity and free zone entity, both are related and they are having transactions, or the transactions with the connected persons. So those are the areas which are of more concern in case of UAE. So we have to focus on the same, and for the transfer pricing, we know that in order to get the comparables, we require the database. But as this law is new in UAE, so as per the OECD regulations, if in any country there is no such comparables, so comparables in the region, within the regions can be used. So prior to UAE, many other countries like KSA and Qatar have introduced the transfer pricing provisions in this region, so that data can be used. But yes, finding the comparables will be very difficult. Databases, I think government may come up with some flexibility in case of comparables, because they also know that the comparables like transaction between mainland and free zone are not going to be available freely at this point of time. In coming future, it will be available, but right now it will not be there.
But the transfer pricing will be applicable for all the companies, right? Yes. So far, the companies over here, they don't follow the transfer pricing because it is the new one. But the transfer pricing it will be applicable for all the transactions, whether it is within the UAE or outside UAE. Correct? So there are so many methods, or there are close to 5 methods are there which the company should follow. One of the methods to ensure that the transfer pricing, they maintain arm's transaction. This is a new concept which is going to be there in UAE.
Okay. So in as per the PCD, it appears that they are going to introduce transfer pricing for the international transaction as well as for the domestic transactions. And if they are going to make it a provision that we have to follow the OECD regulations as other jurisdictions in the Middle East have done, then in that case, mainly finding the most appropriate method, finding the comparables. Prior to this, every company has to do functional analysis in detail, which covers the FAR, which generally known as a FAR analysis, function, asset, risk test, and those analysis must be done with a proper care, because up till now, because there was no direct tax, corporate tax, or transfer pricing in UAE, so finding such type of documents will be very difficult. So every company can utilize this 1 year period to make all their documentation robust and as per the requirement of the transfer pricing. Because I have some experience in few of the companies where I have seen that even their business is at a very large scale, but the agreements are not on place, and their all other documents are not there because they are not required or supposed to share it with any other tax authorities or any other external parties. So now this year has to be used for the proper functional analysis, so that we can find out proper comparables, and accordingly we can justify the most appropriate method. So likewise, all these things are very, we have to do step by step. So first thing is to make everything in place. We have to make our books of accounts in compliance with the transfer pricing. We have to do our documentation as per the requirements of the transfer pricing. We have to maintain all the agreements, because we have seen that generally when the agreements are between the two related parties, no one cares that whether it is properly drafted. Maybe there are chances that in agreements there are something which is not favorable from the transfer pricing point of view. So all those things needs to be taken care.
Okay, thank you for the clarification. Next question to you, Amit. So what do you think, how tax authority will treat the tax group between VAT and the corporate tax?
Right. So far, I would say both our taxes are different. One is an indirect tax where one has to collect the tax and give and pay to the authority. Another is a direct tax where one has to pay out of his taxable profit. And if we talk about that tax grouping, in that also the conditions are different. Just to compare, if we say that in corporate tax, what is proposed is that the parent company must have 95% of the shareholding. And contrary, if we check the condition, the shareholding condition with VAT, it talks about only 50%. So yes, if we compare the first condition, it qualifies, yes. If the any group is being I would say formed on the basis of shareholding capital, then same group will be taken for the corporate tax also. But in corporate tax, it excludes some members. We say the exempt person and the free zone person cannot be a part of a tax group. However, in VAT group, that was not a condition. Free zone companies were also allowed to be a part of the VAT group. So that would be a point. And third condition is about with respect to the financial year. So from the I would say generally any group is there, all the entities in that group usually follow the same financial year. So I don't feel that third condition will going to make any question. Only the point is that whether what the VAT group one already is having, whether I would say free zone company is included or being a part of that group or not. That would be the question. If let's say somehow what is not being provided in PCD, somehow if free zone company would also be allowed to be a part of a tax group in corporate tax, even though one condition is there, if they opt for the 9% taxation, they can be a part of a tax group. If that condition can be overruled or any new clarification would come, then in that case, the similar condition can be carried forward for corporate tax and VAT. And even though if it is not, it won't be there. It would be same like what is there right now. At least 60% of the tax group would be in a position to carry forward the same tax group what they have in VAT, as per my experience only.
No, because of the inconsistency in the rules and applicability between the VAT and the corporate tax, will there be any confusion? Will there be more confusion between the companies? So whether they have to follow for the VAT a different tax group and for the corporate tax at a different tax group?
Basically, VAT, I would say, is based on a transactionary tax, where intergroup transactions are happening, or the VAT is applicable on a transaction basis. However, in CT, it's all about the taxable profit, overall profit. So there are two different sets of rules are there. Even though tax grouping would be same, and members can become a part of both the groups, but yes, working wise, analysis, I would say planning wise, one need to be segregate and give a different thought and give the different understanding to both the groups.
Oh, okay. Yeah, please.
So I would like to add one point. The difference between the CT and the VAT group is, in CT they have mentioned that the administration and payment will be the responsibility of the parent entity. And in case of VAT, it is within the group, they have to designate one responsible person, and the administration and payment of the taxes is the responsibility of that responsible person. So I think when the final law will be there, and on the basis of the suggestions given by the various stakeholders and the taxpayers and entities in UAE, government may provide the provisions for designating responsible person in CT also.
Okay, thank you. Thank you. Shruti, the public clarification document, particularly on the free zone, between the free zones, the trading for goods and services is 0%. But for the services, it is not mentioned whether it is going to be 0% or it is going to be a 9%. So whether do you think that 9% tax will be applicable for the services, or in the when the final decree will be out, so there also there will be more clarity. Currently for the services between the free zones, it is at 9% based on the reading of the public clarification document.
Yeah, so it's like you just specified that it only talks about the trading activity, and in my presentation also I've covered that services are it is something that needs more clarification. So as of now, we can presume that because it is not specifically mentioned under 0% corporate tax rate, we can presume it to be 9%. But yeah, going forward, let's wait for the law to come to get more clarifications on that.
Okay, just for the members, just keep a note on it. Basically, in the public consultation document for the services, it has been mentioned between the free zones, it is at the rate of 9%. So basically, the public consultation document, it's a 33-page document only. If you remove for the first 2-3 pages, then it's only 30 pages. It's a simple document, but it has been explained in various stages, each and every activity. I request all the members to go through the public consultation document, which will give a good understanding. Hopefully by the next month when the decree is out, then we'll have more clear understanding. Okay, the next question to you only, Shruti. Regarding to the salary, where the common promoters are there, between the free zone and the mainland, how it will be treated on the salary with regarding to the corporate taxation?
Again, for this thing, it is nowhere mentioned in the public consultation document, and it is still very unclear. And we are also thinking whether benefit can be taken by one person who's the owner of the business, one person company kind of a thing. So even we are not clear if a person who has income from free zone and from a company, how that will be taken care. So again, that is unclear, so we are waiting on more clarity for that.
Okay. Again, another question with regarding to the salary itself. In case if there are more, basically currently there is no restriction with regarding to the salary to the managing partner or to the members or to the board members. Will there be any restriction with regarding to the disallowance of expenditure? With regarding, is there any cap going to be there for the expenditure or the salary with regarding to the group promoters or anyone?
Again, that depends on whether the income, which is the person who's earning that income, and whether that will be taken as a 0% rate or not. So then again, that expenditure will, like they mentioned, that the list of expenses which will be allowed and disallowed is going to be a long list. So let's wait for this head of income of expense, whether that will be allowed or not.
Okay, fine. Okay, because due to the paucity of the time, in fact, I've been asked to close it as soon as possible. But if there are any questions from the public, then we can carry on at least another 2-3 questions. Then otherwise we'll close it after one or two questions. Yeah, it's already one. Yeah. Neeraj, your voice is so loud, you can ask. Everybody can hear. There is no need for you to have a mic.
Hello. Yeah. The question which was raised by the moderator on the free zone income, where he was talking about
Passive income.
passive income, yeah. So just to elaborate on that further, suppose an entity has an income which is from mainland, as well as between free zones, and as well as from outside UAE. So how is that being segregated in terms of taxation? Any of the panelists, please.
Yeah, if we just go by the PCD, what is provided, so I can say the business firstly need to understand and need to carve out their operations, because since they are doing everything, it means free zone to free zone business is there, free zone to outside UAE business is there, passive income is there, and plus they are doing business in mainland also. So if we checked only one condition where it says that if any free zone company is getting the revenue or is transacting the business with mainland company, then their incentive that is being provided will be waived off. I mean, it will taken away. That total in revenue would be charged, total taxable profit for free zone would be subject to 9% instead of 0%. So I would say to understand further about the passive income, yes, we can expect more clarity. How even if the condition is like there, where the free zone company is having a passive income, plus they are doing business, means active business they are doing with the mainland and the outside UAE, and how to market out. I believe from a personal, I would say my view is that passive income would remain exempted. However, for others, they will club it all together and will be subject to 9%.
Okay, thank you.
Because most of the free zone companies also have investment in the mainland. So basically, they, particularly with regard to the rental income or so many other income also is there. So there also there is no more clarity is required. Currently, it is only talking about a passive income.
So if there is no passive income, the whole of the amount will be taxed?
The whole of amount will be taxed right now based on the documentation which has been given.
I have one question on tax group. I think eventually we may not have a choice whether to make a tax group or not. They will define whether under what conditions you are compulsorily mandated to make a tax group. But suppose we make, I think Amit can answer that based on your example that you shared. Once you decide to be a part of the tax group, can you next year decide not to be a part of the tax group and come out of it?
Yeah, it is also a very important question. Reason being, well, if PCD talks about that, how to add subsidiary to form a tax group, but there nothing is provided for the removal. So yes, I would say it would be this. We can expect some conditions on that, but that condition would be stringent. Reason being, if you are allowing to form a tax group and take the benefit of, I would say, set off and carry forward without any condition, which you are allowing some add-on, I would say, benefits, then in 1 year that company would take the benefit, in second year would take the benefit, third year when they are started earning profit and withdrawing their membership will not be that much easy. There would be some condition likewise like what the condition, we have condition for the VAT also. If there been any withdrawal from the member, from the tax group, VAT group is there's some condition which is very difficult, and it's very difficult to get approved. Likewise, we can expect some condition in corporate tax as well.
And a quick question to Shruti. So the definition of free zone as per corporate tax and designated zone as per VAT is different. So like designated zone in VAT is bounded and all those things. But here I think all free zones are exempt from taxation.
Yes, so for that specific condition that I spoke, that free zone for the designated zone in VAT, only that transaction will be taken as 0%, but yes, otherwise it is 0% taxation.
No, yeah, to answer your question, yes, all free zones will be classified. All the 53 free zones.
Thank you very much. Good afternoon, everybody. Hello, good afternoon, everybody. My question is on the subjectivity involved in accounting when it comes to...
A little bit louder. I know we are waiting for the lunch.
Hello.
Yeah, this is the last question. Huh?
My
Thank
question
you.
is about the subjectivity involved in accounting when it comes to IFRS. The public consultation document actually talks about IFRS related accounting is allowed for the purpose of deductions. So if you take IFRS 9 and IFRS 16, I mean, there is a lot of subjectivity involved there. For example, it could be used for the purpose of tax deferment by using the rates, which you can decide. In the case of 9, you can define your various, buckets, and then you can define the rates, and then provide the expected credit losses, and it could be used as kind of a tax planning tool by anybody. And also, when it comes to IFRS 16, you can use the discounting rates and also your rental terms and conditions, especially when most of the rental properties are coming in from the owners themselves. So we could easily use it as a tax deferment kind of tool. There is a lot of subjectivity involved, even if when it comes to IFRS 16 and 9, and also when it goes to 15, I mean, the milestone payments and all those kind of things, could be easily modified and used as kind of, deferring, recognizing the revenue. So, and also when it comes to depreciation, I mean, this is another one, there is no standardized kind of rates provided. So all these things, put together, it could be used as a kind of, massive tax planning tool wherein the authorities have not come up with anything uniform across all businesses. So what do you think? Is it going to create a problem, or where people use different kind of rates and everything, and after 3 or 4 years, if authorities come back and say that, look, this is not how you have to do it. So what's your take on this?
So in the PCD, they have very clearly mentioned that we are going to take the accounting profit as the taxable profit, and the exceptions they have mentioned that whatever allowances or whatever disallowances will be there, we will specifically mention in the law. So right now, for example, they have mentioned about the entertainment expenditure, that they are going to disallow it by 50%. So the things that the companies are required to make their accounting books as per the IFRS or any generally accepted international accounting standard. So they have very much clear that if you are following that, so tax authorities will not question what type of arrangement or what type of entry you have made. Yes, but they have all the rights to go beyond the financials in case those IFRS standards have not been complied with. If those IFRS standards are for the benefit of the company, then it is up to the company to take the advantage of the same. But they have made it very clear that they are going to take the accounting profit as the taxable profit, except for the disallowances which they have mentioned.
Just my one question to Mr. Amit. Amit, if a company has been registered as a tax group which has 3 subsidiaries, and of which one is a loss making, and that loss has been taken off as a set of 75% of the revenue. So now that subsidiary in the next year gets sold off to the acquired company. Does the acquired company gets the balance set off to be taken as a group for the new company?
Firstly, you are saying that they are the part of a tax group, right?
Sorry?
You are saying that company which has been sold off was a part of a tax group earlier.
Yeah, in the previous year. And the say a loss is 1 million, of which 250,000 is utilized by the old group. Now the new group takes over. Does the 750,000 which is remaining can be taken by the new acquired company as a loss?
So with respect to the carry forward, if we talk about particular company who was earlier the part of a tax group, and after that it was been sold off. So there firstly two conditions, 2 points need to be checked. Firstly, whether it would be allowed to remove the member from the tax group. If it is allowed, then what would be the condition? They may put up the restriction that any loss which is pending there cannot be carried forward. or even if they allow it, then we one need to check that shareholding, 50% of the shareholding must remain same. If it's not remain same, as you are saying, let's say 100% of the business been sold. So what the business is being carried out, whether the same or similar business is being taken care by the new shareholders, new owners, there are questions on that. But important part would be that if you are removing it, what would be the condition that law will going to
No, you have
enumerate?
sold off. So you have to anyways remove it, right?
No, that's the point. If one entity is there already in the one tax group, first you have to remove it
Correct.
to sell it off, right? What would be the condition? Definitely question would come up. Okay, if you can sell it, but that any carry forward is there, any loss which is there in the books that
Dear Krish and all the speakers, we have 2 more mementos left. So who are missing? We have 2 more mementos left. Yeah. So may I request senior member Jayaprakash and committee member Aditya and Suma on stage to hand over a memento to our own Krish. Last, to hand over the memento to our speaker, Janardhan, may I request CA Sandeep Arora and CA Anand Gupta on stage.